Okay, very good evening to you all. So we are starting the session 8 of this course, Money and Banking, which is about the exchange rate and the central banking. Then starting with the lecture outline, today we are going to discuss on the impact of change in exchange rate on economic stability, and later some of key theories that attempt to explain the exchange rate determination, and finally the way in which the central bank can influence the exchange rate. So, before starting the session, as an overview, I suppose you already know what is exchange rate, right? Simply, exchange rate is a price of one currency in terms of another currency. So, that is the exchange rate. So, why we have to learn on this exchange rate, or what is the link between the exchange rate and the central bank monetary policy? So this exchange rate is a very important variable that the central bank has to watch, regardless whether the central bank uses an exchange rate targeting regime or not. So maybe some of the central banks, some of the economies follow exchange rate targeting regimes. Some might follow inflation targeting regimes, or monetary targeting regimes, or flexible inflation targeting. No matter what the regime that the central bank or the economy follows, no need to necessarily it to be a in exchange rate targeting regime. This exchange rate is a very important macroeconomic variable that central bank always keep on eye on it. Okay. So starting on the impact of change in the exchange rate on the economic stability. Here, theoretically, we can explain what might happen when the exchange rate fluctuate on the monetary stability, financial stability, or as an overall on the macroeconomic stability. So before that, I hope that you can clearly remember the definition of these terms: monetary stability, financial stability, and macroeconomic stability. All these terms we have discussed during the previous sessions of this course. The first one, monetary stability. Simply, that is the stability in the currency in general, right? Considering both domestic and international prices. So, what might happen if the exchange rate fluctuates? What might happen on the monetary stability? Theoretically, the movements in the exchange rate can have implication for the central bank pursuit of monetary stability as well as financial stability. For an example, let's suppose that if a country depends heavily on energy imports, then let's assume that the exchange rate of this particular country is rapidly depreciating. So what might result on the economy on this situation? Considering this situation, we are heavily dependent on the energy imports, and meanwhile our exchange rate is rapidly depreciating. So then what might happen? If we consider Sri Lanka, then the exchange rate in terms of Sri Lankan rupees to US dollars. So when our exchange rate depreciating means, that means our currency, the Sri Lankan rupees are, the value of the rupees are decreasing. That means our currency is weaker now. So if that happens, the price of the energy in foreign currency, we have to pay more to purchase these energy products. That means the price of the energy imports will go up, right? So the energy prices in terms of the domestic currency will go up. So that might cause a fast rise in the consumer price inflation, and it might screen into the inflation expectations of the general public as well, right? So now you see this fluctuation of the exchange rate, ultimately at the end it might cause an impact on the monetary stability. Not only that, if we talk about the financial stability, that is the resiliency of the financial system to internal and external shocks. This exchange rate fluctuations can cause a huge impact on the financial stability as well. So, how that can happen? For an example, let's suppose if a country has a high proportion of public or private debt which is denominated in foreign currency, again Sri Lankan situation this is right, we have a huge debt burden in terms of foreign loans. So suppose that again our currency is depreciating. So if there is a sharp depreciation in the exchange rate, what might cause on the debts of this particular economy? Obviously, this debt denominated in foreign currency could balloon when measured in terms of domestic currency, right? Suppose that we have $1,000 worth of uh, debt that has been taken from US. Now our foreign exchange rate is depreciating. Then that means for $1 we have to pay more rupees. Initially it may, for $1 it's 180 Sri Lankan rupees, but since there is a sharp decrease in our exchange rate with respect to US dollars, now we have to pay, let's suppose, 200 rupees for a $1. Then even though the dollar amount of the debt is not changing, it is $1,000 indeed, but in terms of domestic currency now we have to pay more, right? So that means our debt in terms of domestic currency, the foreign debt value will go up, right? So, if this country does not have a reliable source of foreign income, this will affect the country's ability to repay its debt, right? Ultimately, it could lead to a financial crisis. So, this is what happened in Asia and Latin America in 1990s because of these sudden sharp fluctuations in the in the exchange rate. Ultimately, it created the financial crisis. So, regarding the monetary stability as well, if we consider the great inflation during the 1970s, this is what happened regarding the exchange rate and the monetary stability. So I suppose now you have an idea how might this exchange rate cause an impact on monetary stability and financial stability. If I recall again, monetary stability is the stability in the general prices, right? Considering both domestic and international purchasing power. If our currency is depreciating rapidly, if the exchange rate is depreciating rapidly, that might change the prices of our imports and exports, right? Ultimately, at the end, if our prices of imports will go up or if the prices of exports will go up, at the end it might cause inflation within the economy. So that's how the monetary stability can be affected through the exchange rate movements. Then later the financial stability, that is the stability in the financial system to internal and external shocks. So this financial stability can be altered because of the fluctuations in the exchange rate. How that can happen? In a case of highly debt-driven, foreign debt-driven economy, then when our currency depreciates, in terms of the foreign debt, if we calculate the debt in terms of domestic currency, then the burden goes up, right? So that's how it might ended up a default risk for this particular economy because the value is going up when the currency is depreciating. So not only the monetary stability or financial stability, but there can be an impact on the macroeconomic stability as well. How that can happen? So macroeconomy as in the real economy, right? So this can be in either way, maybe an impact on the output or maybe an impact on the employment, or can be both, right? So for an example, let's suppose that this economy is rely heavily on export. So if our currency vastly appreciated, if our exchange rate is vastly appreciated, then what will happen to the export prices? Appreciation of the currency or the exchange rate means our value of the domestic currency is going up, right? The strength of the domestic currency is now going up. Appreciation means that. So if that happens, now the price of the exports might go up, right? If the domestic currency appreciated, the price of the exports will go up, then our exports will be less competitive in the international market, right? So then this, because of that, there might be a fast fall in the demand for the country's exports, and maybe the country's domestically produced products as well, right? So since our exports are now going down because of the prices are higher of our exports, then it might ultimately affect the output of the country as well as the employment of the country, right? When the prices are going up, our product become less attractive in the international trade, international market, then the demand for our exports will go down. At the end, it will result many failures in the export sector industries, right? So the employment in these industries as well as might get affected. So that's how this exchange rate might interfere into the real economy, maybe to the output, maybe to the uh, employment, right? It might cause unemployment and also a reduction in the overall output in the economy. So now you have an idea why this exchange rate matters, right? It might cause an impact on the monetary stability, financial stability, as well as the macroeconomic stability. But so far, I discussed the theoretical aspect. Theoretically, this is what should be happen if a currency depreciated or appreciated, right? Theoretically, if our exchange rate appreciated, theory suggests that the export prices will go up and the demand will go down for the exports. But in practice, in practical scenario, the situation can be changed. Not always the appreciation will lead to a deduction in the export. So in practice, the defining the impact could be quite complicated, depending on many various factors in the economy, right? For an example, if we discuss about these hedging instruments, especially the students from the finance department, they are much more familiar with these hedging instruments, right? Forward contracts, futures. So these are the financial instruments that we use to hedge the risk in the foreign exchange transactions, right? Because we know that there is uncertainty in the exchange rate. We don't know precisely what will happen in the coming uh, durations, right? In the coming periods, we don't know whether our currency appreciate or depreciate. So these investors or these international traders might use these hedging instruments to mitigate the risk in the foreign exchange transactions. So if that happens, this appreciation or depreciation of the exchange rate might not cause such impact on the monetary or financial or macroeconomic stability, right? And also, the adoption of more flexible exchange rate regimes, which familiarize the importers with exchange rate volatilities, also cause less impact from the exchange rate fluctuation to the economic stability, right? If that country adopts more flexible exchange rate regimes, then this impact might be lesser from the exchange rate fluctuations. Not only that, if we consider this pass-through effect of the exchange rate on inflation, it also varied among different sectors of the economy as well as among exporters and importers. Even though in general, in theory, we say that if the currency depreciated, exports will go up, it might not be the practical case for some of the exporters, right? So from exporter to exporter, importer to importer, the impact can be changed, right? So now you should be able to identify and explain the theoretical aspect as well as the practical aspect, right? If I ask you a question, what is the impact of exchange rate fluctuations on the stability of the economy as an overall? Please do not limit your answer only to the theoretical explanation. Explain the practical aspect as well, especially if we consider this recent Sri Lankan economic context. We experienced a huge depreciation of our currency, right? Suddenly a sharp depreciation happened to our domestic currency against US dollars. But theory suggests that if the currency depreciated, exports should accelerate it. But Sri Lankan context, did that happen? To some extent, there is a increase in the export, but not at an expected boost, right? So our exports not much accelerated on an expected level. Why is that? These things can be backed from various factors like export diversification, the demand for the exports, or the market-based factors, and also these import-export elasticities. These factors much more separate stories considering the exchange rate, right? So you should be able to nicely connect the theory with the practical aspect. If the practical aspect is totally different or contradictory to the theory, you should be able to define it. Even though theory suggests this, in the practical aspect for Sri Lanka, this did not happen. That is the rationality that we expect from the university undergraduates, right? Sorry. Now we are going to discuss some of the key economic theories which attempt to explain the exchange rate determination, right? So now we say that $1 worth of 182 rupees. So how we decide that? We should trade $1 for 182 rupees. Who decide that exchange rate? What are the factors that determine this exchange rate? Right? So there are several key theories that gives you the foundation of determining the exchange rate in the economy. So some of one of the very famous theory that we use to define the exchange rate determination is the purchasing power parity theory. It's a PPP, purchasing power parity theory, right? So this purchasing power parity theory, you might learn this during your very first year of the university life for the course microeconomics, right? So, and also for the some of the courses offered by another departments might also explain this purchasing power parity theory. This is a very famous and very simple theory that gives you the foundation on the exchange rate determination. All right. This purchasing power parity theory is totally based on the notion of the law of one price. So what is this law of one price? So, under this theory, there are several assumptions that we made. One is we assume that the markets are perfectly efficient. If you want to write down, please note it down. The assumptions of the purchasing power parity theory. One is the markets are perfectly efficient. Then secondly, the first one is the markets are perfectly efficient. Secondly, we assume that goods can be transported freely at no costs across the borders, right? Goods or services can freely transported across the borders at no cost. That means no transportation cost. So this is not the practical situation. This is kind of impractical, but we take the assumption to build up this theory. No transportation cost. That means without any cost you can import or export good or a service from one country to another, right? So apart from these two assumptions, we assume that the price of identical goods should be the same everywhere in the world after adjusting for exchange rates. That is the law of one price. If you want to note it down, I will repeat it again. Goods can be transported freely at no cost. Then the price of identical goods, we say the goods are identical. That means the similar product, all the content, the process of production, everything similar. The identical goods should be the same everywhere in the world. Price of identical goods should be the same everywhere in the world after adjusting for exchange rates. Okay, so that is the law of one price. Then we shall go to an illustrative example to explain this purchasing power parity theory. Suppose there are two countries in this international transaction, USA and the Germany, right? Now, there's only product that has been traded between these two countries, which is a pen. So this pen is identical product both in USA and Germany. That means the same product, no any difference of this product in the two countries, identical pen. And there are no trade barriers and there is a perfectly efficient market, right? So these are the assumptions we made. So this is the exactly the same example which is in your reference book. Now, this identical pen cost 1.5 US dollars in USA and 1 euro in Germany, right? $1.5 in USA and 1 euro in Germany, right? So, according to the purchasing power parity theory, since this identical product should be same for the two countries, the price should be same for the two countries after adjusting the exchange rate, this purchasing power parity theory suggests that the exchange rate between the US dollar and the euro should be 1.5 US dollar to 1 euro. That means we can purchase one, or to purchase 1 euro we have to pay 1.5 US dollars. If this purchasing power parity theory holds true in this economies, right? So based on this identical product, now we determine, since $1 product in the, sorry, 1 euro worth of product is cost $1.5 in USA. So then we say 1 euro should be worth of $1.5. So that is the purchasing power parity exchange rate. But let's suppose the exchange rate determined in this market is $2 for 1 euro. That means for 1 euro we have to pay $2. Then what might happen in the economy? If that is the case, this German trader can bring this 1 euro to US, right? And convert it into $2 because now the determined exchange rate in the market is 1 euro to $2, right? So if that is the determined exchange rate, what would the German trader would do? He will use 1 euro in Germany and he might go to USA and convert it into $2 because the determined exchange rate is $2 per euro, right? Then now the German trader has $2 in his hand. Then he will use that $2 to purchase the pen in USA, not in Germany, in USA, because in USA the pen costs only $1.5. So he will purchase this pen in USA and bring the pen back to the Germany, right? Now this pen he will sell back in Germany for 1 euro because in the Germany the price is 1 euro. I will repeat the steps again. Now the price of the pen is $1.5 in USA and 1 euro in Germany, but the determined exchange rate in the market is 1 euro per $2, right? Or $2 per 1 euro. Then this German trader, because of this change, the difference between the determined exchange rate and the purchasing power parity exchange rate, this German trader would seek a profit opportunity in this situation. So this German trader go to USA, convert 1 euro and take $2 because that is the determined exchange rate. Then using this $2, he might purchase the pen in USA by paying $1.5. Then he might take the pen into Germany back and sell the pen to 1 euro, right? But if you can remember, since he had $2 after converting the 1 euro into dollars, he had $2 in their hand. But the pen is cost only $1.5. Now he has 0.5 US dollar, which is a risk-free profit for the German trader. If we convert this $0.5 into euros, that is 0.25 euros. For this conversion, we take the determined exchange rate in the market, $2 per euro, right? So now the German trader earned a risk-free profit of 0.5 US dollars because of the change between the purchasing power parity exchange rate and the market exchange rate, right? So since this opportunity is there in the market, all these German traders might go to USA, convert their euros into dollars and purchase the pen from USA and sell it back to the Germany for a 1 euro and earn a $0.5 worth risk-free profit, right? When this happen, what is happening in the economy, when this repetitive process happen, the demand for the USA dollars will go up. Why is that? Because the German traders convert in the euros into USA dollars. For that they demand the USA dollars. So when the demand for the USA dollar rises, then the USA dollar exchange rate will keep strengthening against the euro, right? Now, the demand is going up means the USA currency or the dollar is now become strengthening. then ultimately it might goes up or it might appreciate. Appreciate as in to purchase $1, now we have to pay sorry, to purchase €1, now we have to pay small amount of USA dollars. So that is the appreciation of the dollar, right? That means strengthening the dollar means the exchange rate or the USA dollar will appreciate. That means per uh, euro we have to pay only small amount of USA dollars now. So ultimately, the repetitive risk-free profit earning opportunities might cause to strengthen the US dollar, and at the end, it will reach the 1.5 US dollars per euro, which is the purchasing power parity exchange rate. So are you clear that even though there is a difference between the market exchange rate and the purchasing power parity exchange rate, because of this arbitration, or we say that if there is a change in the prices of the exchange rate, these traders will engage in the profit seeking activities. So these profit seeking activities mean the arbitration. So because of these arbitrative activities, finally the market exchange rate will be equal to the purchasing power parity exchange rate. If that happens, we say exchange rate reaches its equilibrium. Why? Because now there is no incentive for German traders or to USA traders to go to another country and purchase the product and sell back to their home country, because there is no difference between the PPP exchange rate and the market exchange rate. So that is the background of this purchasing power parity theory. So that is what suggested by the PPP theory. That's how the exchange rate might determine, right? So based on the identical product prices in the two countries, ultimately the exchange rate will determine. Even though there is a gap or there is a difference between the exchange rates, because of the arbitration or the risk-free profit earning activities, ultimately it will come to the equilibrium, which will ended up settling in the purchasing power parity exchange rate. So that is simply the illustrative example for the purchasing power parity theory, right? So when we discuss about this purchasing power parity theory, there are two concepts: absolute purchasing power parity and the relative purchasing power parity. Actually, for the absolute purchasing power parity theory, the foundation is given by the law of one price. So if you want to learn the absolute purchasing power parity, actually that is what I explained using this illustrative example. So this example only consider the absolute value or the level of the exchange rate, not the change in the exchange rate. The level of the exchange rate is considered under the absolute PPP. Now we are going to discuss the relative PPP. That means under the relative purchasing power parity, we consider the change in the exchange rate. That means the inflation differential. In the absolute PPP, we do not talk about the change in the prices of these identical products. If you can remember the example that we just discussed, here we only discuss the price at particular level. That means exchange rate for a level. But when it comes to a relative purchasing power parity theory, we consider the changes of the prices as well. Changes of the prices mean the inflation, right? So we consider the inflation differential under this relative PPP. Alright, so here you have given the definition of the absolute and the relative PPPs. So in the relative PPP, a change in the exchange rate between the currencies of two countries should equal the difference in the country's domestic inflation rate. So let's explain this relative PPP using an example, which is connected to the same example we use for the absolute PPP. Here, let's suppose the pen initial situation, the pen cost $1.5 in US and €1 in Germany. Let's suppose over the year, the price of the pen in the United States has risen by 10%. So this $1.5 worth pen, now the price has increased by 10%. That means now the new price of the uh, pen in USA is 1.65 US dollars. But the Germany, there is no inflation, the same price, that means €1, right? Then the exchange rate at the end of this 1 year period should be 1.65 US dollars per euro, right? Now it's no more 1.5 because of the inflation in the USA. Now the exchange rate increases to 1.65 US dollars per euro. That is the new exchange rate, right? So simply this relative PPP consider the inflation rates in the economies. So it suggests that the price of the, it suggests that when particular, if a if the prices of a particular country increases, relatively that exchange rate also should be depreciated for this particular country. That is clear in this example. Previously, to purchase €1, we are paying only 1.5 US dollars. But because of the inflation in the USA, now we have to pay 1.65 US dollars per euro. That means the US dollar has been depreciated. So this the percentage of depreciation is equal to the percentage change in the prices or the inflation differential, right? So that is the relative PPP. So I suppose now the concepts of absolute PPP and the relative PPP are familiar for you all. Uh, Now, yes, we discussed the absolute PPP and the relative PPP. Then we are going to discuss some of the usefulness of this PPP as a theory or the practical implication of this theory in the economy, right? Actually, this purchasing power parity theory is useful in the understanding of the long run exchange rate behavior as well. So, for that, one practical application of this theory is the Big Mac index. So, you can see this mouth-watering McDonald's burger in the background, right? So, this Big Mac index means a price index or exchange rate index that has been computed based on the price of the Big Mac burger or the burger named Big Mac, which is a burger by the McDonald's, right? So let's take 1 minute break to discuss the Big Mac index. Okay. Now we are going to discuss the concept of Big Mac index. So you know Big Mac is a burger introduced by McDonald's throughout the world. So why we are taking this Big Mac as the identical product? Simply because this Big Mac burger is same for all the countries, right? Because this burger globally produced in the same manner with the same ingredients but locally produced, right? So this burger is produced in the same manner with the same ingredients in different countries around the world, but it is locally produced. That means no imports of raw materials or the ingredients are or found in local context. So that in that context, we can take the assumption of no transaction cost in the international trade into a practical aspect, because this to produce this Big Mac, we are not taking any international transactions. We are locally producing this burger. Okay, so this is the PPP or the absolute PPP concept. The only difference here is the product is the Big Mac burger, right? Now, it is said that this Big Mac index is published annually by the Economist magazine. So this index compares the price of a Big Mac being sold in McDonald's restaurants worldwide, right? So if we move into the next slide, here you can see how this Big Mac index was computed, right? So this purchasing power parity implies that exchange rates are determined by the value of goods that currencies can buy, right? So that is what the PPP means. So the difference in local prices, that means in our case we consider the product Big Mac. So we can suggest what should be the exchange rate between the two countries considering the price of the Big Mac. For an example, if we consider these two countries, US and Japan, you can see that here you can see the burger costs $5 in USA, and here in this country it costs 21, right? Here that means based on this, we can assume that 5 to 20 ratio means 1 to 4, right? So according to the Big Mac index, the exchange rate should be 1 to 4. But if we consider the actual context, what is the exchange rate in the market? Actual exchange rate is $1 is worth 6.4 yuan. But according to the PPP, considering the product Big Mac, it should be only $1 should be worth of 4 yuan, but in practical context it is 6.5 yuan. So we can say that considering the Big Mac exchange rate and the actual exchange rate, we can say the exchange rate is 38% undervalued. Why we are saying that this is undervalued? Because in actual context we are paying more amount of yuan for a $1, but according to the Big Mac index, we have to pay only $4. But in actual context, we are paying more. That means our exchange rate is undervalued, right? So that is the simply the meaning of the Big Mac index and how it works. If we consider the Sri Lankan context for the latest data available month July 2020, here you can see the Big Mac cost 680 rupees in Sri Lanka, but in US it's only US dollar 5.71, right? So we compare these two, and accordingly our Big Mac exchange rate should be 119.09. That means 119 rupees worth of $1, right? For a $1, we have to pay only 119 rupees. But in actual context, for the month July 2020, the actual exchange rate is 184 5.85. That means almost 186. That means even though purchasing power parity index suggests $1 worth of 119, in the market we are paying 186 rupees. That means as a percentage wise, see 36% our rupee is undervalued against the US dollar, right? So this is one practical application of the purchasing power parity theory for the application, right, in the Big Mac index. uh, yes, so that is all about the purchasing power parity. So we discussed the law of one price and the two concepts, absolute PPP and the relative PPP, and one practical application, Big Mac index, and the lastly the limitation. So what are the limitations of this theory? What can be the limitation of this theory? We assume that there is no cost in the international trade, right? We say that if the one product is lower priced comparatively to the same product in another country, we assume that the traders would the purchase the product from the beneficial country and sell it in their country, thereby earning a profit. Simply that means they might do the arbitration to earn this risk-free profit. But in actual scenario, in real life, this might not be the story, because the transportation cost and obstacles in the trade between countries, they do exist, right? So then we assume that there is no transportation cost or transaction cost for a trade between two countries, but in practical scenario it is not the case. And also there are differences in customs and tax rate, and also there are some certain locational specific services as well. For an example, let's take a haircut. Even though the price of a haircut in USA is quite beneficial for us compared to the price in Sri Lankan rupees in Sri Lanka, are we traveling to USA to get a haircut? No, right? So this locational specific services also there. For that, this purchasing power parity theory cannot be applied directly, right? So some of the limitations are these assumptions based for this theory, and also this locational specific services, right? So now this theory, I suppose you can understand fully now. Now we are going to start the second theory, which is the uncovered interest parity, UIP. In the uncovered interest parity, we takes account the investor expectation and the role of the asset prices in the determination of exchange rate, right? For this also we have set of assumptions. So first, we assume that the domestic and foreign assets are perfectly substitutable. That means there is no difference in terms of risk or maturity or whatever the factor if we consider the domestic and foreign assets. Why we are talking about assets now? Because under this UIP theory, we are considering the investor's expectation, investor's perspective to determine the exchange rate, not the goods or not the absolute goods, right? So this is somewhat different from the purchasing power parity. Here we assume the domestic and foreign assets are perfectly substitutable. Then the second one, we assume exchange rate would move to help equalize international investment returns such that there would be no riskless arbitrage opportunity. So I know that the second assumption might be confusing to you all, but we will explain this using an example again. Go to an example. This is the same example in your reference book. Let's suppose now we have two countries again, US and Germany. Now there's an international investor who can choose between investing in a US government bond or a German government bond, right? Now because we are talking about the assets now. So that's why we are considering US bond and a German bond, right? Let's assume that these bonds that we consider have the same risk profile and also the same maturity. The risks are same, the maturity are same. One assumption under this theory, these bonds are perfectly substitutable. That means their risk is same, the maturity is same. So, and also the investor can switch between these two bonds very easily, promptly and seamlessly, we say. That means anytime that the investor wishes to switch from one asset to another, he has totally freedom to do so, right? Then the interest rate have been given to you. Let's suppose for the US bond, you can earn 10% interest rate, and for the German bond, you can earn 5% interest rate. So the only difference between these bonds is the interest rate and also the exchange rate differential, right? Now, for this theory, we are using a particular equation to support this theory. That means this equation in the slide. So R means the interest rate. So we are assuming that at the equilibrium, this condition should be met. That means the interest rate of US bond minus the interest rate of the German bond, that is specified in euro, should be equal to the differential in the exchange rate, right? This ES means the expected percentage of depreciation of the US dollar per euro. What is this ES? That is the expected percentage of depreciation of the US dollar per euro. So we say under the UIP, to determine the equilibrium exchange rate, this equation should be met. This condition should be met. That means the interest rate differential between the two currencies or the two bonds in two currencies should be equal to the expected percentage depreciation of the one currency against the other currency, right? Now let's take this example to explain more. Now you can see that the 10% interest rate and the 5% interest rate is there for the US bond and the German bond, right? So this, as long as this expected percentage of depreciation of the US dollar relative to the euro differs from, that means this ES part of the equation, it is differs from the interest differential on the otherwise identical US and German government bonds, then the investors would expect the returns from investment from these two bonds to be different. So what is the meaning of this statement? Here one bond has the 10% interest rate. The other one has the 5% interest rate. Obviously, you can say there is an interest rate differential. So the irrational investor might think, okay, US bond pays more, so I should invest in US bond. But since these are two countries, in terms of two currencies, for the US it is dollars, for the German it is euros. Then not only the interest rate, they have to consider the exchange rate differential as well, or the expected depreciation of the currency, right, against the other currency. Why? Even though one particular person invests in the foreign bond, suppose a German citizen, a German investor decided to invest in the US bond, then he invests in US bond and take the return back to his country. When he is taking the return back to the country, it is in terms of US dollars, right? That return is with the US currency. So he has to convert this US uh, dollar return back to the German euro, to the euro. Then for that, he has to refer the exchange rate, right? So in that case, he has to consider not only the interest rate differential, but also the expected depreciation of the currency, particularly the US dollars against the German the euro, right? If he is not considering that, uh, he might think that he can earn more by investing in US dollars. But at the moment, when the current expected depreciation of the dollar is higher, then the expected result cannot be uh, achieved by the German investor. That's why they have to consider interest differential and also the expected depreciation of the currencies as well, right? Now you can see here, if we consider the expected depreciation of the US dollar per euro, it is 2%. So it has been given to you, the ES part of the equation. So that is 2%. Then R US minus R euro, that is 10% minus 5% means 5%. But the expected depreciation is 2%. That means it is not equal. That means this is not the equal or the equilibrium exchange rate, right? That means there is an interest rate differential. The return from the investment in the US bond would be greater than that from the German bond, right? After counting the expected depreciation of the currency, which is 2% as well, we have a higher return from the US bond. That means 10 minus 5, that is 5%. Expected depreciation is 2%. That means 3% return we can earn extra by investing on the US bond, right? So the German investors will also invest in the US bond, right? So the investors would continuously switch their investment from the German bond to the US bond. Then what happened? The demand for the US bond increases. So under the monetary economics, we discuss how the bond price and the interest rates are related, right? So when the demand for the US bond increases, the prices of the US bond also increases. When the demand goes up, prices goes up. And there's a negative relationship between the price and the return of the bond, right? Price and the interest rate of the bond. When the prices goes up, interest rate will go down, right? So that's why here we say in the third point, it might cause a reduction in the yield on the US bond, right? Higher the demand because of this uh, prevailing prevailing extra return on the US bond, now we demand more for the US bonds. Then the extra demand for the US bond might accelerate the uh, prices of the bond as well. Then the yield of the bond will go down. So it might reduce the yield on the US bond, right? So then what happened? Ultimately, this interest rate differential would be tallied to the expected depreciation, which is the 2%. Uh, Initially, we had 5% interest rate differential, which is greater than the 2% expected depreciation. Here, I am always referring this equation here, right? Then, here you can see that when the demand goes up, the interest rate, this 10% will go down, and ultimately the gap between the US bond and the German bond interest rate will be equal to the 2%. That means 2% equal to the 2%. Interest rate differential equals to the expected depreciation of the US dollar per euro. If that happens, we say that is the equilibrium exchange rate, right? So that is how the exchange rate is determined under this uncovered interest rate parity, UIP, right? Uh, from the investor's perspective, we examine how might the exchange rate will determine, right? So ultimately, we say that is the exchange rate considering the interest rate of the assets in the two countries, right? Here. Now you can understand the second assumption. Exchange rate would move to help equalize international investment returns such that there would be no riskless arbitrage opportunity. When this interest rate differential equals to the expected depreciation, then this German investors will no more invest in the US, right? There is no incentive for them to invest in the other country. They will invest in their country because there is no difference for investment in the US or Germany. The return comes to the same, right? In that situation, we say that is the equilibrium exchange rate, right? So that is the uncovered interest parity. In uncovered interest parity also there are limitations. The first main limitation is the perfect substitutability. So we assume that this domestic and foreign assets are perfectly substitute. But in practically, in reality, this might not be the case. Why is that? Because this the risks of these assets are not always the same. We assume that the risks are same for the domestic and the foreign assets. That's why they are perfectly substitutable. But in reality, the risk can be changed, right? The risk of the domestic country or the foreign country can be changed accordingly. The perfectly substitute the perfectly substitutable assumptions can be not, maybe not a realistic assumption to be made. And also, the second limitation is the investors might not be as rational as the theory assumes, because we always assumes under the UIP when there is the interest rate differential which is greater than the expected depreciation, always the rational investors will go to the other country and invest in their bonds. But in practically, in reality, the investors might not be as rational as the theory assumes, right? There can be a bias. Maybe some people think some people are biased towards investing in their home country rather investing in a foreign country, because we don't know the context or the economic actual situation of the foreign country. We are much familiar with the home country situation. Because of that, we might prefer the home country investment over the foreign country investment. Even though there is an interest rate differential, we might ended up being investing in the home country. That can happen, right? Investors can be biased towards their home country. And also regarding the perfect substitutability assumptions, I forgot to mention that this risk profiles are not always same, right? So it can differ from the liquidity, right? But always we consider the liquidity of the financial asset. If we can liquid the asset quickly, then the risk is less. But always we cannot assume that the domestic and foreign assets are liquid as same as the other country, right? We cannot guarantee that. Maybe the domestic country has higher liquidity rather going to the foreign assets. So this perfect substitutability and also the rational investor perspectives are limitation of this uncovered interest parity theory. So if I recall the theory, two theories so far we discussed. The first one we discussed actually the purchasing power parity theory, which is the consideration given on the good, the prices, relative prices or the absolute prices of the good. Accordingly, we determine the exchange rate. Then under the uncovered interest parity, we determine we consider the investor expectations, and based on the interest rate differential and the expected depreciation of the currency, we determine the exchange rate under the uncovered interest rate parity. Now we are coming to the third theory, which is the portfolio balance model. Now we are coming to the portfolio balance model, which is the third theory that we are going to discuss today, right? The first two theories we discussed the limitations as well, right? So this portfolio balance model theory tries to address the real life limitation of this PPP and the UIP, right? So here they include the differences in the riskiness of the domestic and foreign assets as well as the country's current account. So under the portfolio balance model, it will attempt to address the real life limitation of these two theories that we discussed before, right? Here, under this theory, they recognize that the domestic and foreign assets are not perfectly substitutable because there is always a difference in the riskiness. So, the foreign assets and domestic assets are not perfect substitutes. There is a difference in the riskiness, right? So, that is one assumption, that is one realistic aspect of this portfolio balance model. And also, they say that the riskiness of the bonds could come from many sources, right? Let's suppose, for an example, if a country that issues a large supply of bond is more at risk of being unable to repay the bondholders, right? When the bonds mature or the other things being equal. But why we are saying that? If the country issues unmanageable stock of amount of large scale bonds to the foreign sector or to the economy, to the international economy, at the end, at the maturity, they might not be able to pay back the bonds, right? So there is a risk. And also, let's suppose a country with a lower productivity, then again it is more likely to default on in bonds. For an example, let's suppose we invest, there is a higher risk, there is a higher return for an Ethiopian bond. I am not discriminating any country. Or let's say Lebanon. So since there is a higher return for the Lebanon bonds, we invest in Lebanon bonds, right? But in terms of the productivity, because of the ongoing wars and all this dramatic situation in the Lebanon economy, we don't know whether they have invested their money in a productive usage, right? Even though we assuming that we could earn higher return, we will invest in the Lebanon bonds. But in the Lebanon, they will use the money to invest in the war expenses, right? Or some other unproductive usage. If that's the case, most productively at the end, they might default the bonds, right? So that's how the riskiness of the bonds can be happen. So always these investors have to consider this risk as well. There is a particular risk in the bonds in two countries. So we cannot assume that these bonds are perfect substitutes because of the riskiness, right? So the riskiness can come across from different various reasons inherited to the economies. Under this theory, we assume that the investors would hold both domestic and foreign bonds. Therefore, why? In order to diversify their risk and maximize their investment returns, right? Have you heard of this idiom saying that don't put all of your eggs in one basket, right? So if the basket, if you put all your eggs in one basket, if you lose the basket, then you lose all the eggs, right? Instead, if you divide your eggs into two baskets, even if something happened to one basket, you have one basket remain, right? Safely remain with you. So same as the investment here, the name suggests itself, the portfolio balance model. That means here we assume that the investors would invest in both domestic and foreign bonds, thereby to diversify their risk and to maximize their investment return. So there's an investment portfolio, not only the domestic assets or the foreign assets, both assets are there in their portfolio in order to diversify the risk, right? Then we say the interest differential on domestic and foreign bonds reflect not only the expected exchange rate depreciation as prescribed by UIP, but also the risk premium paid to compensate investors for holding the riskier bond. That means here, under the UIP, they say the difference between the interest rate of two countries equal to the expected depreciation of the currency, right? So this RUS minus R euro equals to the ES, that is the expected depreciation. But under this theory, they say this interest rate differential, that means R US minus R euro, is not only the ES, but also the risk premium that they expected from the higher risk, highly risked assets, right? Under the monetary economics also we discuss about this risk premium theory. Do not worry, the other students from the other departments, you can refer the notes asking from our students. They might have good set of notes, most probably. So this risk premium theory explain how this interest rate differential can cause because of the change in the risk profile of the assets. Here, under the portfolio balance model, simply what you have to understand, the interest rate differential would reflect both the expected exchange rate depreciation as prescribed by UIP and also the risk premium paid to the compensate the investors for holding the riskier bond. For example, as I explained before, I am investing in Lebanon. Why? Because their interest rate is higher. Why their interest rate is higher? Not only because of the exchange rate depreciation, but also the high risk in their economy, right? That's why they are paying me a higher return, because there is a higher default risk for their bond. So this interest rate differential include two components. One is the expected exchange rate depreciation, and the other one is the risk premium, which is related to the higher risk bond. So I suppose now you can understand the portfolio balance model as well. Here, if I have put the role of the current account as well as a subtopic, here under the portfolio balance model, we consider the role of the country's current account also as a factor which determines the country's exchange rate. So you know what is current account, right? That is one subpart of the balance of payment account. So this current account represents all these imports, exports, services, and all these tangible, intangible transactions. Here, we see that accumulation of export proceeds over import payments. That means if we have more exports than our import, that means there is a rise in the country's foreign asset. Simply, it means we have a surplus in our current account if the exports are higher than the import, right? So this since these foreign and the domestic assets are not perfect substitutes, and portfolio balance theory suggests that investors often want to hold both foreign and domestic assets in their portfolios, right? Because of the riskiness, right? They want to diversify their risk since they hold both domestic and foreign bonds. Let's suppose that the country's net export proceeds are greater. Net export proceeds means there is a surplus in the current account. Then this net export proceeds would be repatriated back to invest in domestic assets, right? When we are having the surplus in the current account, we might use some portion again to invest in the domestic asset as well, right? So if we do that, the demand for the domestic asset will go up, right? If we use the foreign income or the extra net export income in the current account or the surplus in the current account to invest in the domestic assets as to diversify our risk, then the demand for our domestic currency will go up, right? To invest in the domestic assets, we need to purchase the domestic asset paying with the domestic currency. Then when the demand for the domestic currency goes up, what happens? Our domestic currency might drive up compared to the foreign currency, right? So that means our currency might appreciate, right? The exchange rate might appreciate. So then you can understand that the country's current account also could play a role in determination of the exchange rate, right? So the strengthening of the domestic currency could reduce the country's current account surplus as well, right? So when our currency is appreciated, our exports are much more less competitive, right? The prices are higher for our exports. If that's the case, the current account surplus will decrease, right? So now you can have an idea how the current account can interfere into the exchange rate determination, right? Since the portfolio balance model suggests that we invest in both domestic and the foreign assets. If we are having a surplus in the current account, we will use some part of that surplus to invest back in the domestic assets. So the domestic currency demand will go up, thereby our currency will appreciate it, the exchange rate will appreciate it. That's how the current account is interfere into the determination of the exchange rate, right? So that's all about the portfolio balance model. Now we are coming to the final theory, that is the exchange rate market microstructure. So far we discussed three theories. The purchasing power parity theory, and then we discussed the uncovered interest parity. Then we discuss thirdly the portfolio balance model. Finally, we are going to discuss the exchange rate market microstructure. Here, the exchange rate market microstructure name itself explains. So far, all these previous three theories considered or focused on the macro aspect, right? The macroeconomy, inflation, interest rate, current account, economic growth. Likewise, they consider the macro variable. Then what might be the microeconomics or the micro sector of the economy? So under this theory, they consider the microstructure of the economy, right? So the microstructure means basically the individuals or the individual parties in the economy. So can be individuals, can be firms, can be financial institutions. So this is basically under this theory, we are giving the attention to how players in the exchange rate market use information available to them when trading currencies in the market, right? So when based on the available information, they might engage in the transaction in the exchange rate market. Thereby, they might interfere into the determination of the exchange rate as well. So let's discuss how they might interfere into the determination of the exchange rate, right? So normally these players in the economy, these micro players in the economy, they have wide range of dispersed information. So maybe the information on the macroeconomic variables such as future inflation, economic growth, unemployment, or extra, etc. And then also they have some information which is announced by the central bank as well. So overall, there is a wide range of information available for the these market players. So these market players will perceive this information differently. If we consider one firm with another firm, same information will be perceived by these two firms differently, right? For an example, let's suppose the central bank announces, or let's suppose the information on inflation implies that there might probable inflation in the next quarter of the economy. The inflation will go up in the next quarter. But one firm might take that information in a positive way and invest more in the exchange market, and another firm might take it as a negative way, perceive the information as a negative way, and might refrain from engaging in international transaction. Accordingly, the way that the individuals, firms, or the financial institutions perceive this information might cause an impact of exchange rate determination. And also, this information asymmetric problem plays a major role also in this theory. You know, this information asymmetric means the information available for the two parties in a financial transaction is not similar. One party has more information, other party has less information. That is the information asymmetric. If that happens, we cannot have a perfect market, right? Efficient market in the presence of information asymmetry. So based on all these factors, the behavior of this micro sector of the economy cannot be predicted. So they might behave different if we compare the individuals, firms, or the financial institutions. So accordingly, we can say that the exchange rate would adjust almost moment to moment, right? So for an example, let's suppose the central bank made a particular announcement regarding the interest rate hike. So the central bank announced that they are going to cut the policy interest rate. So that is the central bank announcement. So this announcement might be taken into consideration under the from this microstructure or the micro sector differently if we compare firms, financial institutions, and individuals, right? Accordingly, their behavior might cause an impact on the exchange rate. So movement to movement, based on the behavior of these micro agents, the exchange rate will be determined. So that is the basic foundation given under this exchange rate microstructure. Yes. So far we discussed basically four theories which are giving you the foundation to determination of the exchange rate, right? If I summarize all the four theories we discussed so far, first, from the purchasing power parity theory, we know that the central bank allows inflation to rise persistently, then ultimately the exchange rate is likely to be weakened, right? So that is what the relative PPP suggested. If there is inflation in one economy, their currency should be depreciated. So that's what suggested by PPP, relative PPP, right? So if I consider the uncovered interest parity, which is UIP, then we know that if a country interest rate is higher than that of another country, then its exchange rate will have to depreciate over time, uh, such that total returns from investment in these two countries would be equal, right? If there is an interest rate differential, ultimately this arbitration might cause to returns to become similar in the two countries. That's what the UIP suggested. So thirdly, if we consider the portfolio balance theory, portfolio balance model, there we know that the assets of different countries differ in the riskiness, and because of that they are not perfectly substitutable as the uncovered interest parity assumes, right? So under the portfolio model, they suggest that always the rational investors would diversify the risk by purchasing both in the domestic and the foreign assets, right? So they have diversified portfolio in their investment accordingly, and also together with the current account of the economy might determine the exchange rate, right? And finally, the exchange rate market microstructure, there it says this microstructure theory, we know that the fluctuations on the exchange rate on continual basis might be resulted from the behavior of the micro structure or the micro sector, individuals, firms, and the financial institutions in the economy. So we cannot say these four specific theories are uniform theories in the practical aspect. Only these theories are doing is giving the foundation to the overall determination of the market exchange rate. So we cannot say that the PPP is true for the particular country. It can happen or it cannot be happen as well. For a one country, purchasing power parity theory is the theory that gives the foundation for the determination of exchange rate. But for another country, it might be the exchange rate market microstructure. So country to country, economy to economy, central bank to central bank, this theoretical foundation may be changed. But overall, what we have to identify is these four theories, these basic four theories give you the foundation in on what basis the exchange rate might be determined, right? So here the next part, the how the exchange rate might interfere into the macroeconomic variable, and the remaining part might take another 1 or 2 hours to explain, because I don't want to speed up the explanation since this might be a bit difficult for you to understand. So I hope let's wind up the session today for now.